The broadcast is now starting. All attendees are in listen-only mode.
Hello and very good afternoon to all. I'm Sachin Mathur, and on behalf of Care Ratings, welcome you to our live webinar on Indian sugar sector. We appreciate your time in joining us for this webinar. To take you further on this webinar, I would like to introduce you all to our speakers for today, Jyotsna Gadgil, Gaurav Dixit, and Ravleen Sethi. Jyotsna Gadgil is working with Care Ratings as a director and has an industry experience of more than 20 years. Gaurav Dixit is working with Care Ratings as associate director and has industry experience of over 13 years. Ravleen Sethi is working with Care Ratings as manager large corporate ratings and has an industry experience of over 8 years. I would like to inform the participants that the discussion will be in the form of a presentation which will be visible on your screen. In case you have any queries, may I request all to key in their questions in the slot provided. Also request if you could key in your name and company details. May I now request Jyotsna to begin with the presentation.
Thank you, Sachin, for the introduction. Good afternoon, everyone. I welcome all of you to Care Ratings webinar on Indian sugar sector, time for implementing long pending reforms. Sugar industry is anticipating a bumper crop in 2017-18 after 2 consecutive years of scant sugar production. This has been mainly driven by better availability of water and good price for sugarcane. In anticipation of the same, sugar prices have started softening. The average domestic ex-mill realizations have fallen to approximately 3,400 rupees per quintal in the current sugar season as compared to the average ex-mill realization of rupees 3,600 per quintal in the last sugar season. The rebound in India's sugar production will add to global surplus in 2017-18. India's consumption growth is flat. Also, global sugar demand is set to fall for the first time in 2 decades as a result of health concerns and taxes on soft drinks, etc., as per the United States Department of Agriculture. So, Government of India has initiated steps to control sugar prices by imposing stock holding and turnover limits on sugar dealers, increasing the import duty, which has provided safeguard to sugar industry. Today itself the import duty has been hiked to 100%, which gives some support to the sugar prices. Further on in today's presentation, we will discuss how this can also be considered an opportune time for implementing reforms, which will address the cyclical issue of the sector, such as tackling with surplus sugar stock. The government can look at the cane pricing policy as the prices of sugar are still relatively firm, as well as sustenance of ethanol sector, as this is one important segment which will help the sector in adverse sugar years. So now I request Ravleen to take you forward from here. Over to Ravleen.
Thank you, Jyotsna, and a very good afternoon to everyone. Let us begin with a brief overview. India, being the second largest producer of sugar in the world after Brazil, produces nearly 15% of the global sugar production, and it is also the largest consumer. As we all can see in the graph where we have listed 10 largest sugar producers globally, India produced nearly 20.3 million tons in 1617 in the global total of 170.8 million tons. Moving on, as we all know, sugar industry is an important agro-based industry that impacts rural livelihood of about 50 million sugarcane farmers and around 5 lakh workers directly employed in sugar mills. Further, employment is also generated in various ancillary activities relating to transport, trade servicing of machinery, and supply of agriculture inputs. Today, Indian sugar industry's annual output is worth approximately 80,000 crores. As on July 17, there are 732 installed sugar factories in the country with sufficient crushing capacity to produce around 33.9 million tons of sugar. The capacity is roughly distributed equally between the private sector units and the cooperative sector units. Further down in the graph, we have shown state-wise share in the country's production mix. Three states, namely Maharashtra, UP, and Karnataka, contribute approximately to 75 to 80% of India's sugar production. Moving on, let us have a look at the production and consumption trends in India. As we all can see in the first graph that India generally produces more than its demand for consumption of sugar. However, with sugarcane production coming down for two successive sugar seasons, 1516 and 1617, sugar production moved downwards from 28.3 million tons in 1415 to 25.1 million tons in 1516 and further down to 20.3 million tons in 1617. Although with a favourable monsoon, there has been a trend reversal in the current sugar season. The production is expected to surpass the demand due to increased cane planting and sufficient soil moisture amidst the satisfactory rainfall in key producing areas. Sugar production in India is expected to increase to 26.1 million tonnes in the current sugar season 17-18, which will be approximately 29% higher as compared to the last season's production. This, as I just said, is on the back of normal monsoons and high cane acreage in the key sugarcane producing states. Not to forget, production of sugar even depends on recovery rate of sugarcane. As we all know that the recovery of sugar has improved significantly in Haryana, Punjab and Uttar Pradesh during last few years. Early and improved variety of sugarcane has resulted in an increase in recovery rate, especially in UP, where the average recovery rate as recorded for the last sugar season was around 10.67%. The current season may witness a further jump in recovery of approximately anywhere between 0.5% to 1% in some of the cane blocks in UP, which further shall support the estimated increase in production as just discussed. Further, as a second graph on this slide will help us understand the actual production so far in the current sugar season. As against the expected production of 26.1 million tons in the first 3 months, which is October to December, production grew by almost 26% to 10.3 million tons, as against 8.19 million tons in the similar period of the last sugar season. So out of the estimated increase of 5.8 million tons, as just discussed, 2.14 has already come in, and the balance is expected in the remaining period. It is well depicted in the graph that UP and Maharashtra have contributed the maximum output so far. Let us now take a look at the trend of stock position in India and the estimation of the stock India is expected to close with by the end of the current season. As we all see in the first graph for our reference, the season started with a balance of 3.88 million tons in October 17, and by clubbing our estimation of production, which we just discussed would be 26.1 million ton, the total availability of sugar is estimated to be around 29.98 million tons, wherein we are not assuming any imports or exports during the said period. Against the availability, the consumption, after assuming 2% increase over the last sugar season, is estimated to be around 25 million ton, which shall leave a balance of 4.98 million ton of sugar for the start of the next season. The carryover of the stock would be sufficient to meet approximately 2 to 3 months domestic consumption requirements before the next season's harvest start. Further, if we take a step forward to understand how the production will look like in the sugar season 18-19, as also estimated by us in our second graph, if you can all see, An increase of 6.5% in the sugarcane acreage has already been reported by the government for 17-18. This strengthens our production of India achieving roughly a sugar output in the range of 28 to 29 million tons for sugar season 18-19, which is definitely subject to normal monsoons in the upcoming season. However, as the growth in the consumption is flat, the same shall be around 25 to 25.5 million ton, which will again leave a balance of around 7.98 million ton at the end of 18-19. Now, if that's the case, this is likely to put pressure on domestic sugar prices. However, the entry of the bulk buyers like confectioners, beverage makers, sweet makers, at every dip in prices may provide some cushion to the domestic sugar prices. So what we can infer from our last slide is that India is again slowly moving towards a production surplus. Surplus sugar in India, as we all know, depresses the sugar prices, which results in massive losses to the millers and cane price arrears of farmers, thus putting the industry in the vicious circle. We therefore need to plan in advance for the upcoming surplus. This we'll be taking up after having a look at the global sugar scenario, as the global patterns definitely have an impact on the domestic scenario. Moving on, as we all see, the global consumption of sugar has been showing a rising trend on a consistent basis. On the other hand, global sugar production declined by approximately 7% from 177.42 million tons in sugar season 14-15 to 164.74 million tons in sugar season 15-16, causing a global sugar deficit after 4 consecutive seasons of sugar surplus. However, the global sugar stocks are expected to move towards surplus in 17-18 after 2 consecutive years of deficit. According to United States Department of Agriculture, the global sugar production is estimated to increase by around 5% year on year to approximately 180 million ton in 17-18. On the other hand, global consumption is estimated to remain at 16-17 levels, which will be 172 million tons. As a result, surplus is expected. Consequently, sugar futures on ICE have witnessed softening of prices in anticipation of world setting for a record high output. We'll take a look at the price trends in domestic and international market in a while. Firstly, what we would like to conclude after going through the current domestic and global scenario is that world is slowly moving towards sugar surplus, with India definitely having a bigger chunk in the same. The scenario is well depicted in the graph as well. With the country slowly moving towards surplus after a year or so, there will be pressure on the mills to generate cash flows to pay the cane price of farmers on time. Surplus sugar production depresses the domestic sugar prices, which shall affect mill cane price paying capacity, which in turn will lead to cane price arrears. So on one side, there is nothing one can do about the sugar surplus. But if you look at the brighter other side, one can take early steps to achieve the surplus sugar availability. Our next slide takes us through the gist of the same. One way to dispose of the surplus is to export the same into the international market. With a view to improve domestic sugar prices sentiments, the government can fix the minimum indicative export quotas like they did in the past. Industry can export greater quantities and is at liberty to export raw, white, or refined sugar depending on the global market demand. The current global prices are also under pressure. However, India is located very closely to 2 large sugar deficit countries, which are Bangladesh and Sri Lanka. They cumulatively import approximately 3.5 million tons every year, and India has bilateral free trade agreement and SAARC free trade agreement with both of them. So government can definitely plan to explore some opportunities to export to these countries. On the other hand, another option which can be explored is product diversification. Here we are basically talking about converting the surplus to ethanol. Ethanol is an agro-based product mainly produced from a byproduct of sugar industry, namely molasses. In year of surplus production of sugarcane, when sugarcane prices are depressed, the sugar industry is unable to make timely payment of cane price to farmers. Ethanol can be an important byproduct which can be used to stabilize the revenue stream for the sugar sector. Hence, in years of surplus sugar, some of the sugar can be diverted into ethanol. 1 million tons of surplus sugar can be diverted to produce 60 crore liters of ethanol. However, the ethanol prices should be remunerative enough to compensate for the loss in revenue which would have come from sugar. We'll take this up later in detail in our presentation, where we'll talk about the ethanol blending program and the current scenario of the same. Moving further in our presentation, let us now have a look at the domestic ex-mill prices of sugar. Moving in tandem with the production consumption scenarios in the country, the average sugar prices touched a low of rupees 24.92 per quintal in sugar season 14-15 due to rise in sugarcane production, and it averaged higher in sugar season 15-16 and 16-17 on a year-on-year basis on account of lower sugar production in the country in these years. As we all know, sugar prices are sensitive to demand-supply scenarios. With the better output numbers for the current season, the expectation of further increase as already discussed in the next season's production and improved global supply prospects, sugar prices did moderated in the current sugar season. However, with the recent measure taken by the government to increase the import duty to 100% is likely to keep the prices range-bound at least till March to April 2018. Moving on with the next slide, we shall quickly take you through to the trends in international sugar prices too. Raw sugar prices in international market fell continuously during March to June 2017. The fall in prices can be attributed to high production in Brazil and Russia, expected output recoveries in India, and the emergence of European Union as a major sugar supplier due to end of the production quotas and allocation of more acreage in China. As we see in the graph, raw sugar prices fell to a low of 13.53 cents per pound in June 2017 from 22.92 cents per pound in October 2016. As on December, the raw sugar future prices were trading at 14.43 cents per pound. Higher import duties in India have so far prevented cheaper imports from flooding the Indian market. Government increased the import duty from 40% to 50% in July 2017 and further to 100% in February 2018. Owing to fixed cost of production for Indian players, the government will have to continue to resort to protectionist measures in the form of higher import duties in the environment of globally depressed prices to safeguard the interest of the Indian sugar millers. So basically what we can summarize after seeing the price trends in India and global market is that adequate output in current sugar season, along with the expectation of a noticeable production jump next year and the softening of global prices are likely to keep sugar prices in domestic market under pressure. However, the government support measures are expected to keep the fall in prices restricted and be range-bound. Moving on, as we just spoke about the prices, let us understand the grain pricing mechanism in India. I would request Gaurav to take us further from over here.
Thanks, Ravleen, and good evening, everybody. In terms of the cane pricing policy in India, the cane prices are determined either through SAP or FRP, depending upon the policy of the respective states. While the Commissions for Agricultural Cost and Prices determines FRP for sugarcane based on various parameters such as cost of production, recovery, expected sugar prices, intercrop parity, transportation cost, and few other factors, the price is not linked to actual sugar prices, which are determined by the market forces. In the same way, few states such as Uttar Pradesh, Tamil Nadu, Punjab, Haryana, and Uttarakhand determine their own SAP, which are not linked to sugar recovery and are usually higher than the FRP. The main problem with the approach of fixing SAP is that they are not linked with sugar recovery or output, and in the event of high sugar production leading to subdued prices, as has been the case in 2014-15 and initial months of 2015-16, higher SAP leads to accumulation of cane arrears. The situation aggravates when SAP is significantly higher than the FRP. Now further, as we can see in the next slide on the cane pricing policy, FRP for the current sugar season has been fixed at Rs 255 per quintal, which is linked to a basic recovery of 9.5%, which is about 11% higher than the FRP payable for the similar recovery in sugar season 2016-17. With respect to UP, which is the highest sugarcane producing state, it has also hiked its SAP prices to Rs 315 per quintal for the current sugar season, which is 10 rupees higher than the last sugar season. Now, as it is evident that while SAP and FRP have been rising steadily, the sugar prices have been volatile, reflecting the market conditions. This is distorting the Indian sugar industry, wherein the revenue side is market determined, while the raw material side is controlled. Our next slide will help us demonstrate the impact of this distortion. Now, owing to the depressed domestic prices and higher cane cost, the cane arrears mounted to an all-time high in sugar season 13-14 and 14-15. As you can see in the chart, the arrears were at around Rs 18,000 crores in those years, which was about 42% and 37% respectively of the total cane dues for those years. To ease out the situation, the government had to intervene and extend support in the form of export-linked subsidy scheme, concessional soft loans, interest subvention on working capital loans, etc. to help millers clear the dues. However, with the sugar prices again moving up since the last sugar season, the millers were able to settle their cane dues in a timely manner as reflected by lower cane areas in those years. Now, if you look at the current status due to last year's windfall gains, the millers are in a better shape and hence with better liquidity and availability of bank finance, they are currently able to clear the cane dues on time. As on January 2018, cane price areas for the current season on SAP basis is at Rs 7,826 crore in comparison to Rs 8,982 crores during the corresponding period of the last sugar season. Further, as per the government data, out of Rs 57,608 crores that the mills collectively owe to the farmers for the sugar season 16-17, payment of only Rs 52 crores on FRP basis and Rs 1,076 crore on SAP basis remain to be cleared. However, with the crushing of the sugarcane expected to be higher in the current sugar season, if there is further downslide in the sugar prices, the cane price areas can go up by the end of season. The support from the government hence will be crucial in managing the same. This therefore brings us to the long pending need of rationalizing the cane pricing policy. Now, currently FRP is fixed by government while SAP is given by 5 states, and as we discussed earlier, high SAP without any linkage to sugar recovery and sugar prices is not viable and therefore unsustainable. As we can see that FRP has been continuously increasing and SAP has been consistently fixed higher than the FRP in every sugar season. On the contrary, sugar prices have not kept pace. They have even fallen sharply in some years, making FRP or SAP unaffordable for sugar mills. Falling sugar prices are directly linked to market conditions, and government has a limited role therein. High support prices makes the operations of the sugar industry unviable, especially when the sugar prices are depressed with high sugarcane and sugar production, which is again expected in the next sugar season 2018-19. This also very often makes the Indian sugar industry uncompetitive in the global market, and in the years when we have huge surplus and the need to export sugar at prevailing prices, we are unable to do it without the government's assistance in terms of export incentives. In the past couple of years, drought caused a drastic fall in cane production, which kept sugar prices high, and farmers got almost 99% of their payments on time. However, with the normalcy returning and higher production expected soon, cane price payments might come under pressure. Therefore, the current system of cane pricing should be done away with, as it has lost its relevance, and adopting a rationalized cane pricing mechanism is the need of the hour. Now, the next slide gives us a bird's eye view of the pending reforms of the Rangarajan Committee, especially with regard to the pricing mechanism. The Commission for Agricultural Cost and Prices (CACP) for the past years has been continuously suggesting the pricing reforms, wherein farmers should be guaranteed a minimum cane price at the level of FRP. The liability of the sugar mill should be restricted as per a revenue sharing formula, such that 70% of the revenue from sugar and primary byproducts or 75% of the revenue from sugar alone will be the cane price payable by mills. If the cane price as per RSF is more than FRP, the farmers get a second installment over and above the FRP. If the price as per RSF works out to be below FRP, which will happen when the sugar prices are depressed, the gap would be paid from a fund called Price Stabilization Fund created by the government directly to the farmers. It means that the sugar mills will pay as per the revenue realization, that is per their paying capacity. The farmers will get paid on time, while it will also keep cost of production reasonable, ensuring Indian sugar is competitive globally to allow exporting the surplus. On one hand, the farmers will get a minimum cane price at the level of FRP and also the share of high realization when the sugar prices are better, which will be an improvement over the current system of giving farmers only FRP or SAP. Further, the PSF will also ensure that the farmers' interests are safeguarded in all scenarios and they don't get a raw deal. Such a linkage formula between cane price and revenue realization from sugar is universal and is followed in almost all sugar producing countries, which will put Indian industry on par with other global players. Now, having gone through the pressing need of one of the long-awaited reforms with respect to cane pricing, let us further take you through the importance of ethanol in the sugar sector. Ethanol is an agro-based product mainly produced from a byproduct of the sugar, which is molasses. In years of the surplus production of sugarcane, when the sugar prices are depressed, the sugar industry is unable to make timely payment of cane price to farmers. Ethanol can be an important byproduct which can be used to stabilize the revenue stream for the sector. The Ethanol Blending Programme, which was as envisaged by the government, seeks to achieve blending of ethanol with motor spirit with a view to reducing pollution, conserve foreign exchange, and increase value addition in the sugar industry, enabling them to clear cane price areas of farmers. The central government has further scaled up blending targets from 5% to 10% under the EBP. In the year 2013-14, ethanol supplied for blending was only 38 crore litres, which went up to 67 crore litres in 2014-15. The reason for increased supply in 2014-15 was that the cabinet decided on fixed price policy for ethanol from market-driven price policy which was not linked to crude petrol prices anymore. In the ethanol season 2015-16, as an incentive, excise duty was waived on ethanol supplies to OMCs for EBP by sugar mills, and industry supplied historically high figure of 111 crore litres of ethanol, achieving around 4.2% of blending. However, the same subsequently fell to 66 crore litres in 2016-17 due to drought and reduction in ethanol procurement price, and also due to the withdrawal of excise duty waiver in the middle of the contract period. Now moving on to the status of EBP in the current sugar season. At 10% blending with petrol, 313 crore litres of ethanol is required. The Cabinet Committee on Economic Affairs approved a price of Rs 440.85 a litre, up from 38.97 a litre from the previous season, for procurement season 2017-18 beginning December 2017. This improved price attracted more offers, and 140 crore litres have been finalized for the supply in 2017-18, which is 26% higher to the best ever supplies of 111 crore litres in 2015-16. Ethanol supplies are expected to improve on the back of increased sugarcane availability, giving more molasses production and improvement in ethanol procurement prices. Hence, EBP is a vital cog for sustenance of the sector. But there are certain supply constraints that the sector is facing, and the government needs to address the same. Let us take a look at these in our next slide. Now, sugar mills should become energy complexes and produce not only sugar but also ethanol, power and other downstream products, and make the farmers a true stakeholder in the entire value chain. Setting up these facilities by sugar mills will also enable them to pay a remunerative price to the cane growers. To tap the potential and achieve the target of ethanol blending policy, the sugar industry needs to upgrade its technologies and create capacities for ethanol production. As currently, out of the total 530 operational sugar mills, only 181 have the distillation capacity, while only 130 sugar mills of these can produce ethanol. The total current capacities for producing ethanol is around 225 crore litres. The integration of production and milling up to the ethanol production stage, if implemented on a large scale, can ensure an efficient production setup. This is another measure that needs to be considered to ensure a sustained supply of ethanol at a reasonable price. The supply of ethanol normally lags behind the demand for it, partly because ethanol in India is produced from molasses rather than directly from the sugarcane. The sector representatives have been regularly pointing out that allowing the direct use of sugarcane for ethanol manufacturing can provide sufficient availability of ethanol, but this will also require large investments to augment the crushing capacity. The government can support this process by giving concessional loans for increasing the capacities. Further, most of the state governments do not actively encourage ethanol production, few not giving permissions to produce ethanol, others imposing taxes and duties on the movements of molasses. For example, in Tamil Nadu, export of molasses outside the state is not allowed. In UP, 25% of the molasses produced is reserved for use by the potable liquor sector. The dispatches are allowed in the ratio of 1:3 for reserved and free sale molasses. States are controlling molasses through the legislations, and permissions for interstate movement of molasses has to be obtained from the state excise departments in all the states. We therefore need a stable and long-term ethanol production policy, tax incentives and ethanol pricing policy. Now let us see how the sugar production and consumption patterns along with the trend in sugar prices have an impact on the operating performance of the Indian sugar companies. As we can see, the sugar companies have seen a major improvement in their financial parameters, with the companies reporting significant improvement in their profitability and debt coverage indicators. With the improved bottom lines, a lot of sugar companies also reduced their debt levels. As we can see in the chart, the EBITDA margins have shown a sharp jump from about 5% in FY14 to around 17% in FY17. The companies are expected to continue to report impressive numbers in FY18 as well. However, the financial performance and consequently their credit metrics in the upcoming years will depend upon their ability to handle the key factors which are presented in the next slide. The leverage position and the liquidity parameters for the millers will have a strong bearing on their credit profile, as most of the millers have taken advantage of the increased cash accruals and significantly reduced their debt levels. Their ability to maintain a comfortable capital structure will be critical and will also be determined by their working capital management skills. The working capital requirements will go up significantly as the cane season progresses. In addition, the integrated sugar mills will continue to be in a much stronger position to handle the ups and downs of the sector. Further, the supply-demand scenario, which will also be determined by the quantum of import-export, will have a bearing on the credit profile of the millers. Looking at the rating dispersion of the sector, a significant portion of the sugar companies continue to be in the sub-investment category. However, with the government's focus on the sector, the performance of the sugar sector is expected to be strong in FY 17-18. Now coming to the current challenges and the way forward, I'll request Jyotsna to take over.
Thank you, Gaurav. So, in a nutshell, if we summarize, the current challenges that the Indian sugar industry is facing as of now are rationalization of sugarcane pricing policy, planning for upcoming sugar surplus, and addressing the supply constraints in the ethanol sector. The way we can look forward on these challenges is like this. Firstly, the sugar mills should look forward to diversification of revenue through ethanol, power, and other downstream products to provide cushion to their financial health in the adverse years of sugar segment. In order to tap the potential and achieve the target of ethanol blending policy and cogeneration, sugar industry needs to upgrade its technologies and create capacities for cogeneration and ethanol production. Secondly, sugar policy can be rationalized by adopting combination of revenue sharing formula, that is RSF, and FRP, whichever is higher. This mechanism will promote efficiency and aid in removing the distortions in cane pricing, and it shall further help to maintain a low ratio of cane price payable as a percentage of price payable, even in the years when sugar prices are low. Lastly, the sector is definitely looking up to the government to protect the interests of farmers and mill owners by resorting to various protectionist measures. With this, we now open the house for question answer session.
Thank you, Jyotsna. Dear participants, we would now be taking a break of 2 minutes before we come back to take your queries. Meanwhile, may I request the participants to key in their questions. Thank you. The first question is from Ankur. He asks, what are the steps currently taken by the government to protect the interests of mill owners and farmers?
Well, to begin with, the government yesterday itself hiked the import duty on sugar from 50% to 100%. This move is aimed at preventing dumping of heavily subsidized sugar from Pakistan to protect domestic farmers at a time when Indian production is expected to exceed consumption. The move shall also support the margins of the industry players. Also in December, to support the prices, the government had withdrawn stock holding limits on sugar. Further, as we all know, that the government is considering initiating preliminary talks with neighboring Sri Lanka and Bangladesh to seek lower import duty so that the mill owners can export the surplus sugar as well.
There's an interesting question by Mr. Tirupati Shetty. He asks, in the present scenario, that is, the prices are reducing and production level has increased, causing us excess production in the country. Demand for sugar has also gone up due to lifestyle, then why are companies not able to make profits?
Thanks, Rapti. Look, the margins of the mills are basically the differential between the sugar prices and the cane cost. Now, greater the differential, better is the margin. The sugar prices recently have declined due to the expected hike in the production that the country is likely to have. And the operating cost of the mills has also increased in third quarter of the current financial year due to higher FRP and SAP. Now, these factors have caused a slight moderation in the margins of the mill owners. However, with the tight stock situation, the government measures like the import duty on sugar to 100% from 50% earlier are likely to support the sugar prices in the near term. Further, margins are expected to remain stable at current levels. The same will also be supported by the increased procurement price of ethanol.
The next question is from Vikas. He asks, when are the mill owners liable to pay the cane arrears and what are the current levels of cane arrears?
Hi Vikas, as per the rule, mills have to pay cane price within 14 days of supply of raw material, failing which the interest at 15% per annum is charged on the amount due for the delayed payment. So most of the cane areas for 16-17 have already been cleared, and the areas as on date are also lower than the similar period of the last year. Further, as just Gaurav shared in the slides before, that the cane price areas in the current sugar season on the SAP basis are 7,826 crores in comparison to 8,982 crores during the corresponding period of the last season.
question is from Aman. He asks, why has the recovery increased in UP over the past two sugar seasons?
Yeah, that's a very interesting question, Aman. Look, there has been a paradigm shift in the recovery rates all across the state of UP on account of a varietal change and also some new varieties coming in. As a result of which the sugar recovery has improved consistently. Although the area under cane has remained largely static in the state for the past 10 years, cane productivity per hectare and average sugar recovery has gone up. There has been a new cane variety called CO0238, which gives both higher yields to farmers and also more sugar from every ton crushed by the mills. Now this variety is estimated to have covered about 7 lakh hectares, which is close to around 35% of the UP's total cane area in the last sugar season. So given the higher yields from this variety, its share in the overall production and cane crushed by the mills should increase going forward as well, leading to higher sugar production in future as well.
Another question from Trupti Shetty, which is crushing season for sugar, and what are the various conversion steps, that is from planting to finished goods to supply to company?
The crushing season for sugar normally in northern India begins in mid-November and ends by mid-April. So this is the season wherein the entire sugar cane is crushed for the year. Now, if you talk about the various conversion steps, the sugar cane is brought by the farmers to the mill gate, wherein it is shredded and the raw sugar juice is taken out of it, and bagasse comes out as the first byproduct. This raw sugar juice is further purified and a clarified sugar juice is taken out, and mill mud, which is another byproduct, also comes out. And this clarified sugar juice is further purified and sugar crystals are produced out of it, and molasses is the byproduct at this stage. So sugar is one of the very rare crops wherein a lot of whatever byproducts are produced are used in some way or the other. The sugar crystals are then packed and in 50 kgs and higher capacity bags, and then they are supplied to the institutional buyers and then the retail customers as well. Hope this clarifies.
We have another question from Tejasvi. He asks, which are the largest sugar producing companies in the country in terms of capacity installed?
Hi, Tejasvi. So the largest domestic sugar producers in India would be Bajaj Hindustan with an approximately capacity of 1,36,000 TCD, followed by Sri Renuka Sugars with approximately 94,000 TCDs. Also, the next three would be Balrampur Chini with 76,500, and Triveni Engineering Industries and Dhampur Sugar Mills Limited. I hope that clarifies your query.
To the end of our webinar. Thanks again to all the participants for taking their time out and being part of this Care Ratings webinar. We hope the discussion was insightful and look forward to your participation in future also. For any further queries or feedback, please write to us at corp.com@careratings.com. Goodbye for now.